Hello, everybody. Mike Molina here. Well, one of the things that I get asked the most in the current market is, what do I think is going to happen with the economy, and what do I think about all these tariffs, and what do I think about the stock market dropping, and all of that. So I'm going to give you my take on it as it relates to just in general terms, and also in the mortgage industry. I have no idea whether what the current administration is doing is going to work or not. I think there is a sound basis for the principles that they're trying to exercise, and there does seem to be a good pathway forward for success for this, but the jury's still out. We're just getting started. It could go either way, but I'm at least going to outline where we're at as I see it, and where I think that we are possibly headed, and hopefully, it'll all turn out for the best, because regardless of who you voted for at this point, we really hope that they have success, because their success is our success, right? So let me just go over a few things with you, and we'll talk about it. So the first thing I want to say is that it really bothers me about how, look, I don't begrudge the media. Like any company, they're in it to make money, right? And they make money by having people watch their news shows, listen to their podcasts or radio, or reading their publications. If people aren't doing that, then they're not making any money. So, of course, they're going to do whatever they can to get people as excited as possible about tuning in. But unfortunately, a lot of that's done through sensationalism at the expense of what's really going on, and creating a false fear, because nobody cares about the Boy Scout that helped the old lady cross the street, right? But they'll definitely take some time to read all about the horrible car wreck on the freeway and, look at the gory pictures. It's just human nature. It's unfortunate, but it is true. And a lot has been made out of the recent tumbling of the stock market in response to the tariffs. And while I'm certainly not going to dismiss the importance of that, it is not what they're painting it out to be. And again, I don't begrudge them for wanting to get people to tune in, but I think that it should be measured, and that at least if you're going to consume that type of content, that you need to understand, number one, it's coming from a desire to drive people to listen and tune into their programs, and that it is not necessarily an objective analysis of economic facts. And that's how I approach things, because this is what I do. I am going to just give you the raw intellectual approach to the analysis of the data. So with that said, let's talk about the stock market and the crash. So if you look back over the past 6 months, right here is April 2nd, and then we had the first big tumble on the Dow Jones. And this would apply to the NASDAQ or the S&P 500. What I'm about to show you, it's going to be the same story. And looking back, it's like, wow, that's pretty low. That's like 36, 37,000, and we were all the way up to like 45,000. So gosh, we've lost so much value. And you're going to hear on the news, people have lost trillions of dollars overnight in their retirement, this and that. And they are talking as if that loss is permanent, that there will be no recovery. And by the way, that would only hurt somebody as if they were retiring on that day and taking out all of their retirement. And that's just not how it works. No, literally nobody does that. When you retire, whether it's with your 401k or whatever mechanism you have for your retirement, you don't just take it all out. You start getting a monthly annuity or whatever it is, and it takes a very long time. That's the whole point of having a retirement, is that you have that money there and it's going to stretch out for a long time. Yes, there was a huge loss in value. Yes, that's not a good thing. But is it really the world-ending thing that they're painting it out to be? Well, when you look at this chart, looking 6 months back, you're like, wow, that's pretty bad. But what happens if we just look at 5 years ago? Now, if we stretch it back, here's the same April 2nd date, and here's that big dip. Wow, that's pretty significant. But look, we've had major dips like that before, okay? Here, going back just in the past 5 years, and we've recovered just fine. As a matter of fact, it only takes a few weeks or months before we recover, and we're up and going on better than ever before. If we look back 40 years, here's our April 2nd date right here. Here's our dip. Look at how many dips that we've had that have been so much more significant than the one we just had over the past month. And every single time, in a few weeks or months, we recovered, and the stock market went on to go on to be better and bigger than ever. And that's exactly what's going to happen now. So yes, trillions of dollars was lost, but trillions of dollars is already being regained, and it will all be regained, and even more so when things calm down. So creating this narrative that there's been this huge loss and people are going to be suffering is just factually wrong. It is disingenuous. It is dishonest at worst. It is misinformed at best. And here's the reason why it's so infuriating to me personally, because it creates a lot of fear and it holds people up from doing things that are to their economic benefit and their economic good, like buying a home, okay? And here's the thing. For the average American, what happens on the stock market in the short term, I'm not talking about for the retirement, but in the short term, is completely irrelevant to their daily life, okay? It doesn't affect the price of gas for them, it doesn't affect their groceries, it doesn't affect their rent or their mortgage payment or anything like that, okay? The stock market is something that for most people, for the average American, okay, is something that's off in the future for them for their retirement. Some interesting facts for you. The 80% of the stock market is owned by 10% of the wealthiest Americans. The other 12% of the stock market is owned by another 40% of Americans. And the bottom 50% of Americans don't own any stocks at all. So we're talking about something that affects less than half the country, but mostly only 10% of the wealthiest people in the country. Not that it doesn't affect a lot of people in their retirement, whatever, but what I'm saying in terms of day-to-day living and it being immediately impactful, it's not that impactful at all, if it's impactful at all. So please keep that in mind. And what the media is not talking about is other things that are impactful, like inflation. Take a look at this. We've seen declines in inflation now 2 months in a row. Things are getting better. Gas is cheaper. Groceries overall are cheaper. Some things are either flat, but a lot of things have come down. Eggs have come down from $8 down to $3.50, I believe it is. So many things have come down and they will continue to come down. And we're just getting started in terms of this new administration. So we should give it the time it needs to see if they're going to be successful or not. So let's talk about the unbreakable rule, which is interest rates always follow inflation without exception. Here is a chart of the 30-year fixed mortgage rate, which is the pink line, versus the inflation rate, which is the blue line. And as you can see, interest rates always perfectly follow inflation. It's always been that way and always will be that way. So what do we see going on right now? What is the current administration trying to do? And what should you be on the lookout for and thinking might be on the horizon? Well, we have been, for the past 4 years or so, living in what we will say a government-generated demand-based economy. And what the current administration is trying to do is create a supply-based economy. And this is what the differences are. A demand-based economy focuses on stimulating economic growth by encouraging high consumer demand through government spending, handouts, as in during the post 9/11 and the COVID years, and government job creations. However, this methodology usually leads to significant inflation as production is reactionary to the demand and it cannot keep pace with the demand created by the large infusions of cash into the economy. So, that's a very long, complicated way of saying that the reason we have all this inflation is because during post 9/11 years, as during the post COVID years, the government handed out a bunch of cash and also created a bunch of jobs. Remember, the government doesn't produce anything. The government doesn't make anything, okay? The government just spends money. And when it needs more money, it creates more money. And that's what causes inflation. And creating a whole bunch of jobs that you don't need and which infuses all this money into the economy, and printing a whole bunch of money and giving it as handouts to the citizenry just puts all this cash in the economy, and that's what creates inflation. Let me give you a visual aid that will explain. So here is a simple way of looking at it. If we look at the monetary supply, we represent the monetary supply in the whole economy as $10, and all of the available goods and services in the economy as these 10 apples, then that means that we have a cost of $1 per apple, okay? Now what happens when the government prints a bunch of money and creates a bunch of jobs, but the goods and services that are available remains the same? Well, if we double the money supply, now we have $20, but we still have the same 10 apples. So instead of the apples costing $1 each, now because we have all this money in the economy, Each apple costs 2. And that's what we've seen for the past several years, is the amount of goods and services has not gone up, but the monetary supply has gone up. And that has created this record high inflation. And that's what they're trying to combat right now. So how do they solve it? Well, there's many ways to solve it, but I'll tell you how the current administration is trying to solve it. And I think there's some basis for optimism and it seems logical. So they're trying to create a supply-based economy, keeping economic growth in the private sector and not based off of government spending. So a supply-based economy focuses on boosting economic growth by increasing the supply, production of goods and services through policies like tax cuts, deregulation, and other incentives aimed at businesses. The idea is that increasing the supply, the production of goods and services creates jobs, spurs investment, promotes competition, which naturally forces prices down, and ultimately leads to real wage and economic growth as the monetary supply increases proportionate to the supply. Okay? So here's our example again. So if we have the monetary supply of $10 and the available goods and services 10 apples, but now we are focusing on having a supply-driven economy, meaning we're producing more goods and services, we're creating more stuff for people. Well, now we've doubled our apples. We now have 20 apples, and our monetary supply has gone up in proportion to that, but we haven't doubled the monetary supply because that wouldn't happen. Okay, you're going to create more money, but it's not going to be, one for one. So now we have $15 in our monetary supply, but we have 20 apples. So now our apples have gone down from $1 per apple to 75 cents per apple. And that is what the current administration is trying to do. And they're trying to do that in a number of ways. They're trying to do it through the deregulation of banks, various industries, offering tax incentives to businesses, and through tariffs. The deregulation of banks and industries is critically important. It's very hard for people to understand why that's so important because it's not something you can immediately measure, like the stock market falling or rising or an interest rate being this or that value, whatever. The discussions of deregulation of banks and industries sounds something just fanciful and whimsical, and you can't really put your thumb on it, but it is powerful and is meaningful. And when these deregulations start kicking in, you're going to see a huge economic boom because if it's easier for businesses to borrow money, if it's easier for banks to lend money, if it's easier for businesses to create their products and perform their services and not have to jump through so many government hoops and so much government red tape to get things done, that decreases the cost of everything, increases the speed that they're able to produce things, and creates more goods and services in the economy, more businesses competing, driving the cost of these goods and services down, and thus creating more prosperity overall in the economy with more overall wealth for the overall economy, as well as increasing real wages and jobs for everybody. So that is a good thing. And the tariffs are designed, there's many purposes for tariffs. I'm only going to talk about the one as it pertains to this discussion, which is the objective is to use tariffs as a means and a way to onshore domestic production of goods and services and encourage expansion and development of businesses, which will increase production, create jobs, and increase real wage growth and overall wealth in the economy. Just to give you an example, this is a list of just 42 companies that have already announced that they are going to be moving their production to the United States and or investing in business in the United States. A lot of these are in millions, but a lot of these are in billions of dollars. Apple, $500 billion. Corning, $1.5 billion. GE Verona, $600 million. IBM, $150 billion. NVIDIA, $500 billion. These are monstrous numbers. And think about all the jobs that this is going to represent and how it's going to help decrease the cost of the goods and services that these companies provide. That, in my opinion, is a very good thing. So what about talks of the recession? A lot of people saying that tariffs are inflationary and they're going to cause a recession and things like that. Well, first of all, tariffs are not in and of themselves inflationary. Can tariffs cause the cost of some goods to go up? Yes, absolutely. But tariffs are not in and of themselves deflationary. Remember, inflation is caused when the monetary supply increases relative to the goods and services available. But tariffs are one-time price increases on specific products. So while you might see certain products increase in price, overall, the cost of products are not going to go up. Additionally, tariffs, because they are specified price increases on specific products, they actually can have the potential to be deflationary, to reduce inflation. Now, I'm not saying that tariffs is a great way to combat inflation, but what I am saying is that tariffs do have the potential to be deflationary, because if you make a cost of a certain product or service too expensive to buy and people stop buying it, well, that is the whole point of what you're trying to do when you're trying to combat inflation. You're trying to decrease spending so that the economy is not overheated, as they say. So while tariffs will most definitely increase the costs of some goods and services, overall, they are not inflationary. And when they say that on the news, it's unfortunate because they just don't understand how economics work. So what about a recession? Is that going to happen? Well, you heard probably a lot about the recent first quarter of 2025 gross domestic product report. Now, in every economic report, whether it's the GDP or any of the inflation reports, they all have a headline and a core number. So the headline GDP showed that gross domestic product fell by negative 0.3%. Okay, a very small number, but still a negative number. But if you look at the core GDP, which is what really matters, it tells a very different story. Because core GDP is private sector consumption plus private sector business investment. And that actually increased by a whopping 3%. Further, private business investment is up 10%, while government spending is down. And that is so important. Government spending contributes to so much inflation. Having that go down is extremely important. Another part of this report was that business equipment and machinery, which is a harbinger of productivity and jobs and real wage growth, increased by a whopping 22.5%. This is a portent of jobs and wage growth to come in the very near future. This is a huge, huge sign of great things to come, hopefully. So while a recession is most definitely possible, at least currently, economic indicators are not signaling that. But let's just say that there is a recession, just for the sake of argument. Would that really be the worst thing? No. As a matter of fact, I've been kind of hoping for a recession, because from my perspective, from my industry, it'd be a really good thing. And I think it'd be a good thing for most of the country. I'm going to show you why. So this is a chart of home values going all the way back to 1975. Each of these columns represents a recession. This is the date of the recession, and the width of the column indicates how long the recession lasted. As you can see, in each of these recessions, with the one exception of the Great Recession of 2008, home values stayed the same or increased. So out of the last 7 recessions, with the exception of one, home values continued to increase. What about interest rates? Well, that's the really good news. So with every recession, we not only saw a drop, we saw a dramatic drop of interest rates at each of these 7 recessions. So a recession is not the end of the world. As a matter of fact, it could be a great reset for the economy, create a new housing boom, and give a lot of people the opportunity to own homes where currently they are just priced out of the market, either because of home costs and or interest rate or some combination thereof. In the words of Warren Buffett, be fearful when others are greedy, and be greedy when others are fearful. And what Warren Buffett is saying right there is that, like, when we saw the recent drop of the stock market just a few weeks ago, so many people sold, which was the biggest mistake they could have made. They got so fearful and they just sold. And that was the worst thing they should have done. And a lot of people were smart. And while all these people were having fear and selling off, a lot of other people were buying. And now those people have done very, very well. And the same applies to housing. So right now, a lot of people aren't buying. The housing market, while it's not weak, it's not failing, it's not as active as it could be. So now is a great opportunity for people that may want to buy a house to get it on the market, get a home for a good price. Yeah, you'll pay a little bit higher rate right now, but you can refinance in 6 months to a year when rates are lower. And in the meantime, you'll have gotten a home for a much cheaper price, and you'll be able to enjoy the appreciation that you're getting because you were smart and bought a home now. And that's what that quote from Warren Buffett is trying to illustrate, and what I would encourage you to do. So if you have any questions, please don't hesitate to give me a call or reach out to me anytime. I'm always happy to help or answer any questions that I can. Thank you so much for watching, and have a wonderful day.